market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Houses are popping, no signs of stopping. Condos, though, kind of flopping. Welcome to the Hawaii Housing Report. I'm Patrick ONeill with Luxury Homes International in Honolulu, Hawaii, joined by Hawaii economist and principal of TZ Economics, Mr. Paul Brewbaker. Paul, it's great to have you back again.
Aloha. Thanks, Patrick.
All right. We're going to take a trip around the islands. We're going to look at real estate statistics from Oahu, Maui, the Big Island, and Kauai. We're going to bring in Anders Hostelli from Guaranteed Rate, give us an update on the mortgage interest premiums, and talk in general about the economy and, Paul, your forecast for the future. So across the island, there seems to be a little bit of a theme where we have strong single-family home sales due to a lack of inventory, lifestyle choices. Condos seem to be struggling. There's investor hesitation, affordability issues, and there's this big pileup of inventory that's taking place. So let's start on the island of Maui. I'm going to pull these statistics up. These are the latest statistics from the Realtors Association of Maui, or RAM. I understand, Paul, you were just there doing a big presentation. We're going to start first with just a couple things that I've pulled out here. With the single family market, this is the number of closed sales, and we can see that the closed sales volume year to date is down 15%. And here's a chart giving us a look at this, and you can see these are really getting low. Down almost where we were around 2008. When we look at the condo closed sales market, which has some major issues, down almost 30%. And this is definitely down around that 2008 type of volume. When we look at inventory on the single family, up about 26%. And you can see it here in the chart. And condo inventory up about 30%. And Paul, when we push all this together and we look at the absorption rate, we get something called months of remaining inventory, which you're well aware of. And we generally think of equilibrium around 4.5 to 5 months of remaining inventory. Okay. I just wanted to zoom in on this and talk about it a little bit. Anything above the green line considered a buyer's market, below it the seller's market. Clearly in both segments right now in Maui, especially condo, looks like it's a buyer's market. What do you see here? What's going on?
You have to remember condos in Honolulu are an urban core resident type of an asset, right? People live in town because condos are a cheaper housing platform than single family homes. And the employment centers are mostly in town, so it saves them costs of commuting and whatnot. Condos on the neighbor islands are primarily located in resort areas. There's a heavy vacation rental component. In fact, maybe the dominant component, because over time, as the resorts have matured, they've attracted offshore investors who have bought units which may originally 50 years ago have been intended for hotel workers or whatnot, but just the nature of resort, urban agglomerations is that the real estate will be expensive, and the resort developers mean for that to happen, right? And so most workers are commuting to the resorts from elsewhere. The condos in the resorts tend to be more expensive, and they tend to have a higher offshore investor participation, be more subject to speculative investor interest.
Can we talk about Maui right now, the disaster that's unfolding in this short-term rental arena? Can you touch on that lightly? And that this is a big cause of the condo pileup for sure.
No question about it. Let me show you some of the material I presented to the Realtors Association on Maui last week. So as you point out, sales have fallen, and that's consistent with the rise in interest rates you and I've been Anders have talked about for some time now. Unfortunately, the rates have not come down as Anders and I both had hoped and I had expected, for reasons we don't need to get into. But as I've inverted the interest rate scale here, so as long as rates stay, in the 6.5 to 7% range, sales volumes will be low. But what you see in the months of inventory remaining, to which you alluded earlier, is this breakaway with condo inventories piling up. and I've seasonally adjusted here, but just the fact that they've broken away since the wildfires and since legislation at the state legislature and then more recently proposed at the Maui County Council to make it easier for the counties to limit the numbers of vacation rentals, and in the case of Maui's own legislation, to remove a regulatory exception that allowed what they call transit vacation rentals in apartment zoned areas around these older resort, West Maui and South Maui resort areas, allow them to operate, even though it was incompatible with the original zoning. Rather than change the zoning, they're now going to renege on, decades and decades of informal commitment by the Maui Corporation Council, and then later codification of those exceptions by the county council itself. And as a result of this threat to the future of transit vacation rentals, that's what it's illegal name. It's like transit vacation as opposed to a permanent vacation. What are we talking about? But because of this threat, a credible threat to pull the exception that has allowed these condos to be in short-term rental use for so many years and decades, the inventories have built up as investors are trying to exit from those properties, and the prices have fallen 20%. And moreover, the condo prices have fallen like an elevator drop. Unlike the financial crisis and Great Recession of the late 2000s, early 20 teens, where you see the bubble in prices emerge and then a symmetric unwinding of that bubble, and maybe a little overshoot in this period where it was kind of we were looking at a second ago at sort of a buyer's market for underpriced relative. These are prices relative to trend. Unlike that experience, which was a dramatic beatdown of valuations, the current episode is one in which condo valuations have collapsed in just the last 12 months. It's a stunning
Oh,
30% drop in the June to June data. And when you just isolate for a second, notice the single family homes aren't seeing the same beatdown. This is all about changing the rules of the game in the middle of the game, which is what the county has proposed. And ironically, although the county now denies that housing affordability was originally their objective, astoundingly, a study that was commissioned for my colleagues at UHERO to do and investigate how the mechanism of downzoning these properties might work suggested that under three different scenarios, a range of condo median price decreases of 20 or 25 or 40%, depending on how fast the absorption or how fast the velocity of sales was. Uh, a, a rezoning or downzoning of these 6,000 condos that we're talking about would cause price decreases by 2027, which would make them more affordable and available for residents to occupy. But ironically, a 25% decrease already has occurred. And this is important. I got these data from the Realtors Association. If you look at the underlying distributions, now I hate to get technical on everybody, but this is what the distributions of condo prices on Maui looked like a year ago in that blue dot. And then in the year, I'm sorry, in the second quarter of this year versus the second quarter of last year, the more recent data in this heavy line. And you can see that it's the high end prices that are falling, not the low end affordable condo prices as much. The 24% drop is a combination of something closer to 30% at the high end and only a 15% uh, decrease in the
yeah,
lower quantiles of the home price of the condo price distribution. Here's the
yeah.
problem: 1 million, 2 million, $3 million condo prices falling is not going to help the affordable housing
No,
problems. So
no. And we all know the
it's a
affordable housing issue on Maui has been the lack of building of housing
lack
units over the
of
years.
construction.
Yeah.
Build the units. You had a wildfire, build more units.
Yes.
It's really as
Yeah.
simple as that.
And I also note the Condo sales that are selling, days on market, 138 days on market. That's the statistic as it's sitting right now. Yeah, fascinating. Let's jump and take a look at Oahu. We're going to look at the same statistics. So these are the latest statistics from the Honolulu Board of Realtors. And we're going to start with the active listing inventory. And this gets a little shocking to me. First of all, we got home sales up 32% compared to last year. Compared to June of 2023, home sales are up over 40%. When we go back to pre-pandemic, this is where we see that shortage of housing. We're still down nearly 50% in the inventory. But Paul, I want to ask you before we go to condo, this increase in single family inventory, is this the first sign perhaps of a little bit of weakening in this really strong single family home market?
Yeah, that could be part of it. I think part of the story is that long-term interest rates, which were supposed to have continued to come down in 2025, um, got hung up once the new administration began talking about tariffs and really substantial increases in tariffs that would be disruptive to to fulfillment of the original plan to lower interest rates and reach you know a steady state with about a 5 or 6% mortgage rate instead of a 7% or a 3% mortgage rate. So those having gotten off that path, like we had to just stop to think about what tariffs are going to do for the last 6 months, it's left the interest rates relatively high. And some sellers, are motivated to sell for like, changes in life and whatnot that they might have been waiting for a better interest rate moment to list their homes, but they have to go they have to make a decision here at a time when maybe the buyers aren't coming back to the
Yeah.
market.
Yeah, that makes sense. Okay, now let's get to condos because this is where it gets really crazy. Here's the number of condos that are actively for sale, 50% from last year, but compared to June of 2023, up 120%, more than double. I did put a little footnote down below. This is 160% more than there were in 2022. If you're a
Mm-hmm.
condo buyer in today's world, this is really a good sign, right? I mean, it's just really starting to pile up. And if we look compared to pre-pandemic, 2019, condo sales are up where home sales are down. And this is really where we start to see this separation in the two
Yeah,
markets, isn't it?
yeah, yeah, absolutely. I have no doubt that you know, we've talked about this earlier that something profound happened immediately after the pandemic as demand shifted over to single family homes because of their advantages for remote work. But that's a one-time adjustment and it's over now. And if I could show you the an image of the prices here for a second, Patrick, if you'll take that slide down, you can see what's happened since that 2022 moment you were just alluding to, where the condo prices have drifted off of trend. They've essentially not changed in 3 or 4 years. And notwithstanding the fact that interest rates are higher and that makes affordability more of a challenge, single family home prices have continued on a parallel trajectory to the path that was established in the 20 teens when the market was 20 teens when the market arguably was in a kind of a long-term equilibrium. So that means that condos are becoming substantially more affordable relative to the single family homes. When you do the deviations from trend, you can see this where that's that's a window of opportunity for prospective condo buyers that it looks to me in these other data, um, some buyers are able to get through. One more factor, there have been a relatively large number of condos newly built in Honolulu's urban core over the last 5 to years, a substantial cohort of new buildings in the Kakako, Kapilani corridor, and Keamoku Street and whatnot. And you have to remember because of filtering, even though a lot of those are high-end units, building those units like at the top of the building uh, and enabling investors to move there or empty nesters to move there from the houses they were living in the suburbs. Just just building the units creates a pattern of relocation and um, a dynamic in the lower valued parts of the market that frees up units and allows
Yeah.
first time buyers and more investors of more modest means to
Yeah.
become participants.
And interesting when you bring up the new inventories. The new inventory is living in a world all by itself because that stuff is selling out, not really having the types of issues we're talking about on the inventory pile because so
Every
much of
building
that
is
is due
sold
to the
out. It's
vintage.
crazy.
Yeah,
Yeah.
it's really great. And the two new ones coming up by Howard Hughes are really, really interesting. Okay, well, let's shift over and let's talk interest rates. So we're going to bring in Anders Hostelli. Anders, great to see you again today.
Nice to see you guys.
So, Anders, every time we get together, we're waiting for some good news from you and
No.
from Guaranteed Rate. Um, where are we today on the standard vanilla 30-year fixed rate?
Yeah,
Any good
boy,
news to report today?
it's pretty steady as she goes. On Monday rates came down a little bit, but we're right now at 6.5% with about a point or a little under a point. So, I mean, we've been in this range for a while. Now, I know I talked about it last month, but the adjustable rate mortgages have improved a bit as far as rates. So, in other words, like that same scenario, I can get a 5-year fix or a 5-year arm at about 5.875, right, compared to 6.5%. So
That
that's
is substantial.
right. It's substantial. So again, it's a 5 handle, which sounds is better than a 6. And when you look at the difference in what it can do to your payment, that it really obviously helps bring the cost down.
Right. And are you seeing more buyers make that selection to do the adjustable rate?
Yeah, and I think some of it's interesting, even in our industry. Over the last several years, it's pretty much been a fixed rate market, and the shorter, the arms weren't priced that well anyway. They were very close or just a little bit under the fixed rates, but because the anticipation of future inflation has brought the treasuries down, the shorter term treasury down, which is what the arms are pegged to. That's where now we're seeing that the adjustable rate mortgages are pricing better.
Yeah.
So, yeah.
That's good to hear. That is good to hear that separation.
One loan
So
we locked in today is an arm. It's a 5-year arm. I just saw that, in our branch.
yeah,
So,
okay, good. Oh,
mhm.
that's yeah. And Anders, I've got this chart up right now. This goes back to I think it's like 1970, and we can
Mhm.
see this interest rate environment that we're living in. And you and I were definitely around together in the mid 90s in Hawaii. It
Mhm. Yeah.
wasn't a ton of fun. But when we look back historically, this is so interesting to me. I mean, we are in the same rate environment we were in the early 90s. We
Mhm.
really weren't talking about rates being high. It just seemed like that's where it normally would be.
Right.
And then we went through this big low and this big dip right now.
Mhm.
Compare it. How do you compare like the mid 90s to now in the rate
Yeah,
environment we
I
live in?
remember when I got in the business, I think it was 1992 or 93, and everybody was refinancing. It was like, oh my God, rates are so low. I remember 6.875 was, oh my God, it's under 7. I remember doing a lot, this is when I first got in. And I was looking at the borrower's loan that we were refinancing. They were at like 9% or 10%. Because you look on this chart, look in the 80s, right, all the way up until the early 90s, and you can see that little dip in 1993. It's around 94, but then rates
Right.
jumped up right there. But it's because historically you see how rates were so elevated, and then you come into the single digit rates and then under 7%. So when you compare that to what the rates were before that, it's like, it's a huge improvement. The problem that we have right now is that in the COVID years, interest rates got so low, or even before that, if you look at the charts here, that when you compare those very low interest rates to today, that's where you start saying, wow, the rates are so high, but historically they're really not that high.
Right. That's interesting. They were excited to refi at what our rates are today, and we
Yeah,
think that they are
yeah,
so
I
high.
remember that. I can
Yeah, I think
remember
it's going to be an unintended consequence of having the rates so low is
that.
this rate mortgage lock-in problem, which
Hmm.
freezes up all this inventory. I don't know how you get out of it. You've mentioned before sort of the magic rate we're all thinking is around 5.5 to start to get things moving again.
Hmm.
Do you still stick by that?
Yeah, I still stick by that. And I know there
Okay.
are other experts in the market are saying that, yeah, if we could see the rates drop by about 1%, then we'll see definitely more activity.
Okay. All right.
Mhm.
And Anders, you've been really good at predicting the Fed's actions and the interest rates, like all of us.
Well,
Um, just taking a guess. Last time we spoke, you thought maybe two drops in the interest rate, 25 basis points, something like that, by the end of the year. Is that what you're still thinking on the forecast?
I'm still thinking that. I'm still thinking that. I
Okay.
think not the last time I said one drop, but anyway.
Oh, one. Okay.
Yeah,
Sorry.
yeah. But yeah, I think I'm just thinking there's going to be one, maybe in September. That's what I'm thinking. But
And
we
you
shall.
think maybe 25 basis points, 50 basis points?
I'm thinking 50.
50. Okay. All right. I
I
like
would
that.
love
Well,
it if I could actually be right. Like at some
just keep
point.
saying it. One of these
Right,
times you're going to get it 100% correct.
right, right, right.
Anders, okay, one last question.
Sure.
The Hurricane Relief Fund has been
Mhm,
reinvigorated in the state,
mhm.
and
Right.
this goes directly to the financing and the underinsured buildings. Have you, I know it's new, it's just come out. Have you seen anything yet that's affecting the lending?
I haven't seen, I look at condos like every day or so. Like somebody says, hey, can you look at this condo? Then, of course, besides the condo documents and the standard things, but I'm like, hey, how does the insurance look? So we're definitely seeing more condos now getting 100% hurricane coverage with supplemental insurance. I haven't seen any specifically. It says they've actually written it through the Hurricane Relief Fund.
Yes.
Although I know there's a process to be able to tap into that insurance, they have to have been, I think, denied twice or something
Yeah.
to be able to do that. But I was in Maui, happened to be also last week, and I was talking to someone who's at one of the major, the big insurance companies here, and he was talking, and he was saying that compared to last year, the supplemental hurricane insurance that is about 30% cheaper
Oh,
now compared to last year, and he foresees that even now in the next few months that'll hopefully get even
that's
less
good to hear.
expensive. Yeah.
Really good to hear. You and I did a great webinar last year with Sue Savio talking about all these issues and kind of sounding the alarm. And I think we're going to shoot to do an update next month. So if anybody's watching, be sure to subscribe so you don't miss that on the Hawaii Housing Report. Well, Anders, thank you again for being here. Thanks for your time. Thanks for all you do. We'll see you next time.
Thank
And
you.
don't go away. We'll be right back with Paul Brewbaker. We're going to take a trip around the islands, look at pricing as well as closed sale data. And we are back with economist Paul Brewbaker. Paul, anything you want to add to the conversation on interest rates and where you think they might be headed?
Yeah, boy, walking down memory lane there with Andrews, we both were at Bank of Hawaii in the early 90s when those rates were, about where they are now, and what a different world where they had come down to that level instead of now where they've gone up. They've just gone up to that level. I just wanted to resonate with what Andrews was saying about the expectation of lower rates eventually. You'll recall originally these are the blue lines here are the federal funds rate, the rate that the Fed controls. And you can remember pre-election that we were all expecting a continued downward slide in rates, reaching a bottom at the end of 2026. And then came the election and, some concerns about tariffs. So the Fed put things on hold for a while. The expectation, their own expectation, this is their expectation, their own projection is that rates will resume declining in the second half of this year, but take till the end of 2028. So 2 years later to complete the descent. And part of the reason people have been, you know, pressing pause is because of the tariff uncertainty. Just this month, and even just today and this week, a number of those bilateral tariff questions have been resolved. So as we see further resolution, what the tariffs will be and uncertainty, we should move forward into this lower rate period. The business economists expect that the 30-year mortgage rate at the end of this year will be, at or slightly lower than the 6.5% mortgage rate that Anders was talking about. So it's just taken us longer to get there is all.
Yeah, interesting. Yeah, well, it'd be to be seen what happens with
Yeah, I
these
mean, we'll see
tariffs,
what
and
happens.
we'll see. Okay,
Absolutely. Yeah.
all right. So we're going to shoot back, and we're going to look at data from Oahu, Kauai, and the Big Island. So let's go back to the Oahu, and this is the months of remaining inventory. So months of remaining inventory is a great gauge for us because it takes into account the inventory and the pace of sales. And just to remind everybody, equilibrium around 4.5 to 5 months of remaining inventory. Anything above that, buyer's market. Anything below, a seller's market. So let's take a look as we're going to go backwards. So in June of 2019, we see single family and condos tracking together in the threes, in the range of a seller's market. June, obviously a seller's market, down to 1.2 and 2.1. Now we get to June 2024, we start to see separation between condo and single family home. 3 versus 4.7. And then this is where it gets nuts. So the latest data, 3.7 for homes, still in the range of a seller's market, 7 months of remaining inventory on the condo, clearly a buyer's market. Paul, I stole one of your
Oh yeah,
slides and I stuck this green line on
I
there.
recognize that slide. Yeah.
Yeah, this is definitely your slide. But this really gives you kind of a visual to see how far above or how far into we are a buyer's market for condo versus the seller's market, which is showing that continued separation between the two.
Yep. Yep. Just like on Maui, only not quite as bad.
Okay, so let's continue, and we're going to take a look at the Big Island and Kauai. First of all, I want to thank UHERO for the data that they're providing, that we're using here for some of the outer island data. And let's start on the beautiful island of Kauai. This is the median sales price information, which you can see, and you'd alluded to earlier, seems to just keep going up, certainly on a upward trend line. But the volume, this is resale of single family homes on Kauai. You can see this substantial drop off on the Kauai market. If we jump over to the Big Island, we see the single family pricing run up as well. And then the condo pricing also not as affected. And like you said, a lot of this is the resort inventory, and there's not that many sales, not a lot of data. But here's where we start to really see this fall off. So here's the resale number of single family homes on the Big Island. And then when we look at the condo market, we see it's way down and it's trending down further. Paul, is there anything you want to add to that on the outer island data?
Just a reminder that we're all in the same boat, so to speak. In fact, if you lined up some of those Oahu, neighbor island data with Oahu data, and then, for example, you break out Kona, which is much more like Maui and Kauai. They also align with Orange County, California, and San Diego County, California. So we're sort of, we're in the same sort of investor capital world. And we go all through the same ups and downs, whether interest rates are high or low, whether there's something happening after the pandemic or not. And yeah, it's interesting to see that validation for Kauai and the Big Island in the more recent data there.
Yeah. And Paul, just in a general sense, talking about the economy in Hawaii as we're looking into the future, over the next 12 months, do you see any major changes? Do we seem to be on a upward trend, downward trend?
I am troubled by the failure of tourism to really come back since the wildfires on Maui. Um, the Japanese aren't coming back, I mean, mostly because of exchange rates, and I wouldn't expect those to change very much. But I'm concerned that America is sending the wrong signal to the rest of the world, and we're seeing Canadian uh, travel declines show up in the neighbor island markets where they tend to have a preference. Um, Hawaii's economy has some challenges, and some of them are self-administered. Some of them are self-owns. So as a consequence, Hawaii's been underperforming the national average ever since the pandemic. We were matching the country on the way through the 20 teens, but then we detached. Hawaii detached in about 2017, 2018. It's not even a pandemic thing, although the pandemic made it worse. And now, since the wildfire and against this sort of negative vibe that we're sending to the rest of the world, um, there's some challenges out there. I hope the interest rates help revive housing and investment in Hawaii over the next 12 months, but they're crosswinds for sure.
Yeah. Yeah. Okay. Well, Paul, can't thank you enough for making the time to be here and share your insights on the market and what's happening in the economy. And can't wait to hear what you have to say for next month. So, for those of you enjoying this, please do give us a thumbs up down below and be sure to subscribe so you don't miss Paul's insights next month. Until next time, be well, be kind, and aloha.